Day-in swing traders are well aware that any bull market, particularly ones as sharp as this current one, cannot persist forever, and at one point there obviously is going to be a pullback. And often, when rallies are as aggressive as the current one, the pullbacks can be vicious. I'm Seth Freudberg, the head trader of S&B Capital's options trading desk here in Manhattan, and professional options traders like the guys on our trading desk are trained to understand that the intelligent use of options can turn what most people think of as a cost to traders, a hedge, into a standalone strategy that can be a profit engine on its own. So if you're interested in a hedging approach that can be a moneymaker in certain conditions, then I'd stick around because I think you're going to find this interesting. Hi, I'm Seth Freudberg, and I'm the head trader of S&B Capital's options trading desk. S&B Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're valuable. It's no secret that we're in the midst of a raging bull market, historic in nature, fueled by near zero interest rates, vaccine hopes, and fiscal stimulus hopes that all powerfully impact investor outlooks for the future. But just as there's no bear market that lasts forever, as it might have felt for a month earlier this year, there's also no bull market that lasts forever, and a pullback is inevitable. Now, this current rally is stunning, as large cap stocks, as measured by the S&P 500 index, have rallied over 1,500 points in just 9 months, a mind-blowing 68% rally on a broad index. It's unbelievable, and therefore, whether you believe stocks are overvalued or not, there will come a point where there will be a pullback, and with the intensity of this rally, pullbacks can be pretty vicious if there's any change in sentiment. We're in the middle of a pandemic, after all. Suppose the distribution of the vaccines or their efficacy somehow don't meet expectations. What if the fiscal strain of the pandemic results in widespread business failures or sovereign debt problems, as took place after the financial crisis in 2008? Any number of issues can, and most likely will, derail this bull market, at least for a certain period of time. And so if you're like me and you see this as a real possibility, then you might consider how to hedge yourself off from a potentially vicious pullback. Okay, so to put on a hedge for your whole portfolio using options requires a quick review of how index options work. For those of you familiar with index options, this is going to be quick, and then we'll jump back into this hedging strategy. Okay, so a call option on an index is basically a bet on the entire index, a bet that pays off if the index closes above what's called the strike price of the call on the day it expires. If that happens, the call seller pays $100 for each point the index has closed above the call strike price. The call seller is the one who takes that bet, and he charges a price, the call premium, that he believes will be at least enough to cover his risk that the index will exceed the strike price of the call on expiration day. The call seller charges the call buyer 100 times the cost of that option. Now, if the call buyer is right, he gets a payment of $100 for every point that the index exceeds the call strike price on expiration day. If he's wrong, the seller pockets the premium, the option expires worthless and just dies. So for example, let's say an index is trading at 2,000 and a call buyer pays $1,000 to buy a 2025 call on that index. Now, if on expiration day the index closes at 2040, then the call buyer would receive a cash payment of $1,500 as the proceeds of his bet. But if the index closes at or below 2025, then the call buyer gets nothing. The call seller pockets the $1,000 premium he received for taking the bet. Now, an index put option is just the opposite. It's a bet that the index will close below the put strike price on that option's expiration day. And similar to the call, it pays off $100 for each point below the put's strike price in that case. And just like the call, the put option seller receives $100 times the price of the put for taking this bet. So if the index closes below the put strike price, he gets $100 times the amount by which the index closes below the strike price on its expiration day. If not, if the index closed at or above the put strike price, then the put seller completely loses his bets and gets nothing. So, for example, let's say an index is trading at $3,500 and a put buyer pays $900 to buy a 3450 put on that index. Now, if on expiration day the index closes at 3430, then the put buyer will receive a cash payment of $2,000 as the proceeds of his bet. But if the index closes at or below 3450, then the put buyer gets nothing and the put seller pockets the $900 in premium that he received for taking the bet. Okay, now with that understanding, the best way to show you this hedging technique is by a recent example of how this could work out. So let's head back to August, and as you can see, by August 28th, the SPX index had rallied 100 points past its previous all-time high of about 3,400, which it reached in late February before the COVID crash. And so it wouldn't be ridiculous at this point to expect the market to at least test that 3,400 area and pull back into it at a minimum before proceeding upwards, as so often happens. And so what certain options traders will do is to anticipate that kind of a move and go ahead and buy a put option at that former resistance point, expecting such a pull-in. So let's say that the trader decided that the likely scenario is that at some point over the next month, that pull-in is likely to happen. So he buys a 3,400 put expiring on September 25th, which is about a month later. And as you can see, he pays a price of $36.32 on August 28th. Now, before we get into how this hedge works and how it can actually become a profit engine on its own, I wanted to let you know that beyond this strategy we're teaching you in this video, there are a large number of sound, viable long-term techniques for trading options for income. And in that regard, we're currently running a 2-hour free intensive workshop where we'll be teaching you 3 of those strategies that real professional options traders use. In that webinar, we'll be teaching you a really simple but incredibly effective strategy that some of the greatest investors in the world use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if you'd like to learn these strategies, then just go ahead and click the link that should be appearing now at the top right corner of your screen. That's going to open the free registration page in a new window, so don't worry, you won't lose this video. Or you can register for the workshop at optionsclass.com. It's not often that retail traders can be taught strategies employed by actual Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so now we've purchased the 3,400 put expiring September 25th, about a month later. So if we move forward a few days to September 2, you'll see that the index has rallied further up to 3,580, which, as you can see, has dropped the value of the put that we bought to 2,611. And this is going to happen often with a strategy like this. You won't time the move just right. You could have gotten the put cheaper just a few days later if you were psychic and knew exactly when a pullback was going to come. But in any event, the fact that the index rallied further in no way changes the basic thesis of the trade, as we gave this pullback a full month to unfold and we're only a few days into the trade. Okay, so now let's move forward to September 10th. And as you can see, our patience was rewarded here, and the index did in fact break down. And so at this point, we have an interesting direction we can take on this trade, and that is that we can essentially lock in a nice profit on the hedge while maintaining it for further potential appreciation. I say that because you'll notice that with the pullback in the SPX index, the put prices have gone up substantially. So much so that on this day, we can sell the 3350 put, the one 50 further points down, for $76.96, way above the $36.32 price that we originally paid for the 3,400 put. Now let's examine the cash flow of what has happened here to understand why this puts us into such a great position. See, we can sell the 3,350 put for $76.96, which, remember, we multiply by 100 with index options for a cash inflow of $7,696 from selling that option. But the original 3,400 put cost when the index was higher was much lower at $36.30, which again translates into an original cost to us of $36.30. So now by selling the 3,350 put, we guarantee that we're going to make a nice profit on this trade. You see, the absolute minimum profit on this trade is now the net cash flow of buying the original 3,400 put and selling the 3,350 put, which is a little over a positive $4,000, as you can see. And that's illustrated by our taking a look at the hypothetical situation of the market now bouncing to at or above 3,400 by September 25th, when both of these options expire. You see, in that scenario, both of the options, the 3,400 and the 3,350, will have no value because they only have value if the index closes below their strike prices on expiration day. So the trader can just allow those options to expire worthless. But remember, he collected that positive cash flow, so that's his. He gets to keep it. So as long as the market pulls back in time for him to sell a lower strike put for a higher price than what he paid for his original long put, then he's guaranteed himself a profit on this hedge, even if the market ends up bouncing afterwards. But you'll notice that I suggested selling the 3,350, which is 50 points below the original 3,400 put, and there's a reason for that. So now let's move forward to the day that these options expire, which is September 25th. And as you can see, the SPX has sold off another 40 points down to 33.01. And since these options expire on this day, we can look at how they settled, because remember, they settle up in cash once they expire. And so let's break down the final result on this trade. Let's start with the value of the 3,400 put on expiration day. And since the index closed at 33.0150 that day, this calculation shows you that the put expired $98.60 in the money. And so multiplying that by $100 per point, the final settlement value is $9,860. But remember, we had that 3,350 put as well that we sold, and so we're the ones obligated to make a payoff on that one, as we are the put seller in that case. And so as you can see from the calculation, that one has expired $48.68 in the money for a final negative value to us of $48.60. Now also remember that we originally paid $36.30 for the 3,400 put, and we sold the 3,350 put for $76.96. And therefore, if we net it all down, the final outcome on the trade is a profit of $9,066. But what's important to focus on is the fact that this trade was guaranteed to be a winner once we sold a put lower on the options chain for a greater premium than what we paid for buying the original put higher up the chain. And that's because no matter how much farther the market went down, the increases in the value of the long 3,400 put would always, dollar for dollar, offset the increase in the value of the short 3,350 put. And so while the 3,350 put, because we were short that put, placed a cap on the value of the trade, the fact that we're able to lock in a $4,000 profit on the trade early on gave us the flexibility to stay in the trade and play for the larger gain, which ultimately did take place because we were comfortable with that strong locked-in profit that we took place earlier in the trade cycle. And so what I'd like you to take away from today's video is the fact that there are hedging techniques with options that create really unique situations that are not possible with other financial instruments, as we showed you in this example. If you get your timing right, you can take a hedge, which is ordinarily thought of as a cost to a trader, and turn it into its own profit center by locking in the trade's profit through the technique that we showed you in this video, giving yourself some room for further profit, as we did in this case, while locking in really strong gains, even if the market reverses and your original hedge loses value. Once you learn how to trade options with some skill, a whole world of option strategies opens up to you, a world that professional options traders are adept at using to their advantage, where you can get really great risk-reward trade-offs once you understand how to time the trade and use short and long options advantageously. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so you won't lose this video, don't worry. Or just go ahead on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss all the free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.